Hi everyone, welcome back to my channel. Today we're going to talk about the most tested ASPE topic, which is revenue recognition. If you think that you already know the basic concepts of this, feel free to skip to the middle of the video where we talk about advanced topics that even some people studying for the CFE don't know how to answer. So if you like what you see, please remember to subscribe and give this video a thumbs up. I have new videos coming out every week, and if there's a topic or a question that you have, please let me know in the comments below. So the overview for today is that we're going to talk about what is the revenue recognition criteria and what's a tip to memorize them. Then next, we're going to talk about the advanced depth topic, which is gross versus net revenue recognition. And this will apply for both ASPE and IFRS. And lastly, we're going to go through a case example of how to apply the gross versus net concept. So now let's talk about the revenue recognition definition in ASPE 3400. It states that revenues for sale of goods and services is recognized when performance is achieved, provided that at the time of performance, ultimate collection is reasonably assured. So to fully understand what this means, we have to first define what is performance and then what does it mean by collectability. So now let's start defining what performance is. In a transaction involving the sale of goods, performance is achieved when the earliest of all of the following criteria are met. I want to stress that it is the earliest of all of the following conditions are met. The reason for this is because a transaction can meet all of these conditions later on. However, you want to record revenue as soon as these things are met, so that revenue recognition is not delayed. Now let's go into those conditions. The first one is that significant risk and reward of ownership has been transferred from the seller to the buyer. This means that the seller has no more risk of the goods being lost or stolen, and then the buyer has the reward of using that item. The second condition is that the seller retains no continuing managerial involvement in or effective control of the goods transferred. That means the seller has no strings attached to what has been sold. Lastly, the measurement of the consideration can be determined and the extent of which the goods may be returned. In this case, it means that the amount of revenue that you're going to be earning from this transaction can be calculated. And then you can estimate the amount of returns for the revenue that you're earning. So now let's talk about the last criteria in revenue recognition, which is collectability. This is pretty simple. It basically means, do you think you will get the money? And most of the time when you read the case, you'll notice that the money has already been collected. So now that we went through the revenue recognition criteria for ASPE 3400, you might be asking, how do I remember these criteria and how am I supposed to be using this in a case? If you're still watching this video and you haven't liked or subscribed to my channel, I'd highly recommend that you do so now, as videos come out weekly. I try to make accounting content on the CPA process, accounting technical, or just case writing tips. So let me know in the comments below what topics you want me to discuss or if you have any questions, as I try to answer each one of those comments. So here's a template of how I would apply the revenue recognition criteria in a case. In addition, I would use the acronym RCMP to help me remember all the criteria of the revenue recognition. R being risk and rewards are transferred, C being collectability is reasonably assured, M being measurability of revenue, and then P being performance is achieved. Other than knowing that revenue can be recognized at the earliest of when all of the following criteria are met, you want to also conclude with a strong statement saying, I recommend blank. In addition, you want to talk about the impact. So how does it increase or decrease revenue? So now that you know the basics of revenue recognition, let's talk about gross versus net revenue recognition. This is an advanced depth topic that can be used in both ASPE and IFRS. So how you apply this topic on a revenue recognition case is that you would first go through the basics of revenue recognition. So you'll still go through your RCMP, and then afterwards, you'll be at the end where you need to determine what is the total value of revenue you need to record, and that's where this concept comes in. So here's a scenario where this gross versus net concept can be used. Assume an artist gives painting to an art gallery to sell. If the paintings are sold, the art gallery gets to keep 10% of the revenues. So the question here is how much revenue the art gallery should record on their books. Should it be $200 or $20? So if we were the art gallery and we wanted to use the gross revenue method of recording revenue, we would record all of the revenues and then record an expense of what needs to be given to another party. So on the right, you could see journal entries of debiting cash for $200, crediting revenue for $200, and then you'll have cost of goods sold for $180 that we're going to pay back to the artist, and then cash going out for $180. If we were to use the net method, we would only be recording the money that we are getting. So this would be debiting cash for $20 and then revenue for $20. As you can see in both scenarios, the overall net income and cash is the same. However, the revenues are different. So if we were the art gallery, how do we know which method is correct? Should we use the gross method or net method to record revenue? So good thing the accounting standards give us some guidance on how to account for things using the gross method or net method. In the handbook, the party that's recording the revenue on a gross basis is called the principal, and the party that's recording the revenue on a net basis is called an agent. To know if you're the principal, you get to set your own prices, you own the inventory, you're responsible of any inventory risk that's going to happen, and you bear the ultimate collectability risk of your customers not paying. If you're the agent, you only earn a fixed fee per transaction, or there's a percentage of the sales that you get to get. Here's a case that I've made. Let's see if you know how to answer it. TechWiz makes keyboards and has asked Marketing Master to help them sell and distribute their keyboards. These keyboards are all stored within MM's office and shipped whenever a customer orders them. has suggested TW to decrease their price from $120 to $100 per keyboard, and TW has agreed. If more than 50 keyboards are sold in a year, will get $1,000 from TW. All unsold keyboards at the end of the year will be returned to TW. 100 keyboards were sold in the year, and TW has recorded revenues of $9,000. So the question here is, how should TW record revenue of those 100 keyboards, and was what they did correct? So here's how I would answer this question. I would first start with the issue. So the issue statement is that TechWiz recorded revenue of $9,000, but we need to determine if this revenue is recorded correctly. In order to determine how much revenue is recorded, we need to determine if TW is an agent or a principal. The analysis would be TW is a principal if they have the ability to set prices. And this criteria is met because TW ultimately had the ability to set prices. An example of this was when asked them for final approval to adjust the prices. A second point would be that TW owns inventory, and this is also met, as TW takes back all the unsold keyboards at the end of the year. The last one is that there is inventory risk. The reason for this is because any unsold inventory will hold up capital for TW. As you can see, I didn't go through all the criterias of a principal because not all of them applied using the case facts. You can pick and choose the ones that are most applicable. In addition, I also wrote that Marketing Master has characteristics of an agent as they only get a set fee, which is $1,000, if more than 50 keyboards are sold in a year. In conclusion, I recommend that TW record the full revenue of $10,000 and cost of goods sold of $1,000 and cash of $9,000. Thanks again for watching, and hopefully now you know how to use the revenue recognition criteria for ASPE. In addition, you know how to use the gross versus net method of revenue recognition. If you like what you saw, please remember to subscribe. If you have any questions or comments, please let me know in the section below.